Welcome to Growth Wealth Code, where we explain investing concepts in a simple way. Picture this. It's 2008, and the world is panicking. Every night on TV, there's another story about major banks collapsing, stock markets crashing, and people pulling their money out of investments because they're terrified of losing everything. Now imagine, in the middle of all that panic, you actually put $1,000 into the stock market. Sounds crazy, right? But here's the question. If you actually did that at the single scariest point in modern financial history, what would that money be worth today? That's exactly what we're breaking down in this video. We'll look at what actually happened during the 2008 crisis, why people panic sold at the worst possible time, what that $1,000 would actually be worth if you just left it alone, and most importantly, what psychological lesson we can take from it so we don't repeat the same mistake in the future. But first of all, this video does not contain any financial advice. Everything we're covering here is purely educational, based on historical data, not a recommendation to buy or sell any specific financial instrument. Okay, let's break it down. To understand the 2008 crisis, imagine the economy as a house of cards built too high, too fast. Banks were lending mortgages to people who couldn't really afford them. Then those risky loans got bundled up and sold as investment products all over the world. When people started defaulting on their mortgages, one card fell, then another, and eventually the whole house came crashing down. Big banks like Lehman Brothers went bankrupt, global stock markets plunged, and millions of people lost their jobs and their savings. So why does this matter for us trying to learn investing? Because this is exactly the moment human psychology gets tested to its limit. Let's introduce two characters to help us understand this: Peter Perfect and Larry Linger. Peter Perfect is an investor who, in October 2008, right when the market was crashing hardest, still put $1,000 into an index fund tracking the overall stock market. He had no idea the market would fall even further in the months ahead. He just had one simple plan: invest, then leave it alone. Larry Linger, on the other hand, already had $1,000 in the market before the crisis hit. But once he saw his portfolio drop 30–40%, he panicked. He sold everything in March 2009, at literally the exact bottom of the market, because he couldn't stand watching the red numbers pile up every day. He moved his money into a regular savings account, waiting for things to feel safer before getting back in. Here's the catch. What Larry did actually made emotional sense. Who wants to watch their money shrink day after day? But mathematically, that decision locked in losses that technically hadn't even happened yet. And worse, it took him years to work up the courage to get back into the market, by which time the market had already recovered without him. Now let's talk actual numbers. Based on historical S&P 500 data, often cited in research from Schwab and Morningstar, if someone had put $1,000 into an S&P 500 index fund at the lowest point of the 2008 crisis, around early March 2009, and simply left it there untouched until today, that investment would have grown into tens of thousands of dollars. That's because the stock market, even though it fell more than 50% from its peak, eventually recovered and went on to hit new record highs in the years that followed. Here's what's interesting. Peter Perfect, who was brave enough to invest when everyone else was scared, ended up buying at prices far cheaper than before the crisis. He got a massive discount without even trying, simply because he stuck to his plan instead of trying to predict the market. Now compare that to Larry Linger, who sold at rock bottom. His $1,000, sold at a loss, was left with only around $600. On top of that, he kept that money sitting in a regular savings account for years before finally getting back in, missing out on one of the strongest recovery periods in modern market history. Add it all up until today, And the gap between Peter's decision and Larry's decision can add up to tens of thousands of dollars, all because one person held on and the other panicked. And this isn't just some one-off story. The exact same pattern played out again when COVID hit in March 2020. The market crashed hard within weeks. Plenty of people panic sold, and then the market recovered faster than almost anyone expected. Those who sold at the bottom out of fear locked in their losses again, while those who held on, or even added more, ended up with significant gains in a relatively short amount of time. So what does that actually mean for you watching this right now? It means the stock market has historically always moved in cycles. Sharp drops, followed by recovery, followed by new highs above where it started. The problem was never really the market. The problem is what happens in our own heads. The human brain is wired to avoid the pain of loss, and watching your portfolio turn red every single day feels like real pain. Even though technically it's just a loss on paper, as long as you haven't sold. It's not about timing the market. It's about time in the market. This isn't about how good you are at guessing when the market will go up or down. It's about how long you're willing to stay in it. So how do we avoid becoming the next Larry Linger when the next crisis hits? Because let's be honest, another one will come eventually. First, have a plan before the crisis hits, not during it. Peter Perfect could stay calm because he already had a system in place, investing consistently through dollar cost averaging, instead of waiting for the perfect moment to jump in. Second, keep an emergency fund separate from your investment money. One of the reasons Larry panicked was because he needed that money for urgent expenses, forcing him to sell at the worst possible time. If your emergency fund is safely set aside, you give your investments room to grow without being disrupted by short-term needs. Third, diversify. An index fund tracking the entire market tends to be more resilient than putting all your money into a single stock, because you're not depending on the fate of just one company. Fourth, remember that short-term volatility is the price you pay for long-term growth. No investment goes up forever without ever going down. What separates successful investors from everyone else often isn't intelligence, it's patience. I'm not saying one strategy is definitely better than the other. Some people are more comfortable with dividend investing, which provides regular income. Others prefer a more conservative approach. It all comes back to your financial goals, your time horizon, and how much risk you're actually comfortable with. But if we're talking about long-term historical data, the pattern that keeps repeating is this. Those who stay the course through crises are, in the end, rewarded by time. Warren Buffett often reminds us to be fearful when others are greedy, and greedy when others are fearful. John Bogle, the creator of the index fund, always emphasized the importance of long-term discipline over trying to guess the market's next move every single day. So if you're asking, is now the right time to invest even though the market feels unstable? The answer is, it depends on your goals and your risk profile. There's no single answer that fits everyone. What is clear is that the story of Peter Perfect and Larry Linger teaches us one important thing. Decisions made in a moment of emotion often have a much bigger long-term impact than we ever expect. In the end, the 2008 crisis isn't just a story about economic collapse. It's a story about human psychology repeating itself generation after generation. Every time a new crisis hits, the same fear shows up again, and the same choice has to be made again. Hold on or panic. If you found this helpful, hit like and subscribe to Growth Wealth Code so you don't miss out on breakdowns like this one. If you like this video, you'll probably like our video on why our brains are almost always wired to make the wrong call on when to buy or sell stocks, which ties in closely with the Peter and Larry story we just went through. See you in the next video, and as always, stay patient, stay disciplined, and stay systematic on your investing journey.